You are listening to Policybazaar.ae's The Policy Project. We've got you covered.
Debt and credit cards. For many of us, those words sound like a one-way ticket to stress and sleepless nights. But what if I told you that they could actually be the keys to unlocking incredible wealth if used wisely? Yeah, you heard that right. Debt and credit cards can be your secret wealth-building allies. Hello and welcome to another exciting episode of The Policy Project. I'm Sid, your host and your partner on this journey to mastering personal finance and insurance. And today, we're flipping the script on how we view debt and credit cards. Instead of being financial villains, we'll show you how they can become powerful tools to turbocharge your financial growth. And I'm not just talking theory. We've also got an expert here to share practical real-world strategies which all of us can start using from today. So without further ado, let's give a warm welcome to Sachin Desai. He's the business head banking at Policybazaar.ae. Sachin, thrilled to have you on the Policy Project. Let's dive right into this fascinating conversation.
Good morning, Sid. Pleasure to be on your show again. Thank you.
All right, so how can using low-interest debt strategically enhance investment potential in high-yield assets?
Let me put it this way. I would like to quote an example just for the audience to understand it better.
Yeah.
So let's assume that somebody's got 100K, a loan worth 100K, and that would come at, say, 8% or 10% interest rate. Let's consider 10 for ease of calculation. So on a 100K loan, you would end up paying 110K if you take it for a year, right? Now, at the same point, if you've got an investment option, let's say it could be something in real estate, something in the stock market, or some people trade in commodities, cryptos, and all these. So don't take it as a financial advice. For these things, you need to consult a financial advisor so that who can guide you basis your risk profile and also the tenure that you're looking at and also the amount that you're going to invest. So let's say, as an example, you get something like the stock market, and stock market is just an option. It could be any financial instrument which is going to give you 15% or 20%. So on that 100K, you would end up making, say, 120K. Now, against that, when you're paying off your debt, you're supposed to pay 110. So the 10K that you're making extra on 100K is, your profit, your take home, basically. So that's how you can use debt to make a bit more money on the side.
Interesting. Now, since we are talking about credit cards, so there is always good debt, bad debt. So how does the concept of good debt versus bad debt apply to wealth accumulation strategies?
A personal loan or an auto loan or let's say a mortgage. You
Right.
take it and it works out good for you, then let's say the money that you're investing taken through a loan works out in your favor. You make a good decent profit on it. If you take a home loan and that the property value appreciates, these are all good scenarios, a happy path scenario. So this is good debt, where debt is being leveraged for wealth accumulation. Now, the financial instruments could be different, but the end result is the same. Everybody wants to make money. Now, at times, some investment ideas might just not work out for a certain set of audience. Maybe it could be just a bad decision, bad timing. It could be any of these factors. Now, this can lead to bad debt. What happens is, in these scenarios, people end up taking too much leveraged bets. Let's say, for example, with a 20-30K salary, goes ahead and borrows 50% of his or her salary. Let's consider 30%, 30,000 as a salary, and somebody takes up a loans which are the EMIs go beyond, or the credit card spend goes beyond 15K. Slowly, steadily, people start getting into bad debt where they are not able to service that particular debt. It leads to a bad credit history and defaults. So good debt would actually work in your favor if you plan it correctly and you keep a decent risk margin. Bad debt, if you get into it, my suggestion would be cut down on spends. First, make sure that your bad debt is controlled. Start paying your EMIs on time, and always keep some money parked aside. The thumb rule is you should be keeping at least 3 to 5 salaries as parked in your savings account or your FDs, something that you can it acts as a buffer or a cushion in during bad times, right? So please plan your wealth accumulation strategies accordingly and make sure that you're not over leveraged.
And if any help is needed, there's always Policybazaar.ae.
Definitely.
All right. Now, talking about going from good debt and bad debt to the effectiveness of leveraging debt for investments. So, are there any metrics that the investors should consider to evaluate the effectiveness?
Yeah. So one is the basic principle applies that when you're
Hmm.
investing into any leverage debt, even before you get into that particular instrument, you should be looking at the past performance. The past performance not an indicator that you will get the same going forward, because every be it the stock market, the real estate market, cryptos, everything has got a lot of volatility. It's depending on a lot of geopolitical issues and how that particular instrument is going to perform. So, but still, the historical performance gives you a certain, these are guidelines in terms of what kind of money you would make from that particular instrument. So, one is understand the past performance. If you're going to take up debt, make sure that you have a decent margin, that where you can so that at the end of the tenure you make a decent profit out of it. So as I quoted earlier, if you're going to take debt at 8%, make sure that you're investing into something which is at least at a 15%, running at a 15-20%, so that you make effectively 7-8% of it, of your investment, which is a decent sum. The other pieces that when you're looking at debt, you should always be wary about the fact that whenever you're taking debts, it should be within your risk profile. You should always keep making sure that you do not go beyond the 45-50% debt to burden ratio, so that you have enough buffer to service the debt and not get it converted into a bad debt going forward.
Right. Okay. And talking about now credit cards. So
Okay.
obviously there are a lot of rewards that comes with credit cards, right? So if there are individuals who want to use effectively these credit card rewards and they want to enhance their investment contributions, so is there a way to do that as well?
So I would like to answer this question a bit differently. One
Yeah.
is when you use credit cards, you can definitely go ahead and I've known people who use credit card loans and the balance transfer options to actually go ahead and make certain investments which are short term. The other piece is a lot of individuals, and talking about people, since UAE has got a lot of people from the Asian subcontinent, uh, the Asians usually tend to buy a lot of gold,
Hmm.
and they can actually use credit cards, use the 0% EMI options to go ahead and purchase gold, earn rewards, and also make sure that they get an interest free period for depending on the card. It could be 3 months, 6 months, convert to 0% EMIs, and really enhance investment there. Apart from that, they will keep getting reward points.
Okay. And according to you, what are the best types of credit cards to use for maximizing rewards and benefits in wealth building strategies?
When you look at credit cards and looking at wealth building, I would say it's like every month you need to start adding to that pool of wealth that you have, right? So personally, I believe in using a cashback credit card, because cashback is something that you would uh, every individual who's got a credit card and who's using it for all regular spends. Let's say even if that person makes 5,000 spend in a month, and let's for ease of calculation, let's say if the cashback is at capped at 5%, every month if you're going to get 250 bucks back for just using a particular credit card, I think that's a very that's pretty rewarding, because 250 bucks in a month, you multiply it by 12, and in a year you were, just for using a particular credit card, you're getting say $3,000, which is pretty rewarding.
True that. True that.
Apart from
But
that, you can usually have seen people in the UAE on an average use anywhere between 2 to 3 cards. Now, people can actually use the cashback for daily purchases. You can maximize your rewards and benefits when it comes to travel. If you have a travel card on you, you can get discounts on bookings, flight tickets. So that's how, adding every small penny to the pool really helps build a larger wealth pool over a period of time. It's more about being disciplined in your usage, and you can't build great amount of wealth overnight using a credit card. But for the purchases that you make, every drop adds to the ocean, and that's how you need to start putting in the discipline of using the cards with the right intention and at the right place to maximize the benefits that you get from a credit card.
all right. So ये तो बात हुई about rewards. Now, I'm sure there would be some risks associated with the credit cards as well for investments, right? So, what are the risks associated with credit cards for financing investments? And if there are, how can they be mitigated?
So, yes, whenever you're taking debt for a financial investment, it will have a significant amount of risk associated with it. Now, let's look at some of the common risks that come in. One is, the first and foremost is, if you're putting it into a financial instrument, the instrument needs to give you that kind of return. That's the first one, right? The second one is, what's the risk that you carry? Sometimes people are so short of cash that they have to sell their investments even if they're doing well, even before they mature. And when people look at withdrawing money from financial investments before they mature, they might end up with paying a penalty or a redemption cost. The other one is, in terms of, a lot of people rely on credit card debt, which they then park overseas for getting better returns. Now, fluctuation in the local currency wherever you've invested in, let's say if somebody takes a credit card loan and invests in his or her home country, and if that currency depreciates, then definitely the money that you have invested, even if you have invested a million and there's a 10% depreciation, even when you withdraw, you would end up with 900, right? 900K. So currency fluctuations really eat a lot into your, investments. The other one is, a lot of people get into financial investments, but they do not know what are the transaction costs associated with it, where they keep churning their portfolios, and these kind of things don't really give you the kind of return that you're expecting. And all of this, if you're not able to repay your credit cards on time, will lead to a lot of bad debt piling up. It'll impact your credit scores and
Correct.
your access to better rates in the future.
Okay. And talking about credit score, what role does credit utilization play in maintaining a healthy credit roll while leveraging credit for investments?
So when you're looking at a credit card, usually what happens is, the thumb rule is, you should not be going beyond a 50 or a 60% utilization on it, because it once you have done that, usually what happens is, let's say, even if for a person who's got a 10K salary, the banks would offer 3 to 4 multiples of the person's salary as the credit limit. So effectively, a person earning 10K gets a 40K credit limit. And if that guy goes ahead and keeps spending, and let's say spends over 20, 30K on it, the person needs to think about how he's going to pay it back. 20K is what? 20K is two salaries. So the guy can still, kind of recoup that over a couple of months and make sure that the debt doesn't pile up. So that's how the keeping the credit card utilization at 50% really is kind of a thumb rule to make sure that you don't overspend. If you don't overspend, you tend to repay the debt faster or on time. That really helps you build a good credit score. If people max out their credit cards, and then if things don't work out and they're not able to make the payments on time, that definitely takes a credit score hit. And God forbid, if things go really bad and the person starts defaulting on payments and ends into collections and stuff, that delinquency really stops access to any further credit which really doesn't help you going forward if you want to consolidate your debt, because then the banks would be looking at the past history of credit utilization and then realize the guy is not able to make a payment on time or is already into collections. So the banks would be a bit risk averse in extending credit again, considering the previous credit behavior.
Right, right. All right. That was very insightful indeed. And thank you so much, Sachin. Ab, time to move on to our next segment. It's Ask Away. So here we take up FAQs by our customers and we respond to them with the help of our experts. And if you too are inquisitive, if you too are a curious learner like myself, and you've got questions about finance, about insurance, don't hesitate. Just ask away. Slide into our DMs on Instagram, follow us at Policybazaar.ae, or reach out to us via any of the other social media channels, and we'll try our best to answer your questions in the next episode. Today, however, we shall be taking up questions related to the role of leveraging debt and credit cards in significant wealth creation that we've received in our inbox. So, Sachin, ready with your answers to our askaways?
Yeah, go ahead, please.
All right, Ji. So, the first question, it's from Tanuj, and he wants to know, how can I balance debt repayment with investing to ensure both short-term stability and long-term growth? I think everybody wants to know that.
Yeah, Tanuj, a very nice question, I must say. One is, investing is something that requires a lot of discipline, and investments are not built up, all of a sudden. They're built up over a period of time. And as I think it was Peter Lynch who said that, it's not about how you time the market; it's about the time that you spend in the market, which applies to every investment. uh, Investment should always be seen with a long-term plan, long-term view. So, and I completely align with that. So, when you're looking at investing, you can actually use debt for short-term investing and make sure that you could invest it into any of the instruments that you like, be it bonds, stocks, cryptos, real estate. You can always use debt either from a personal loan, a car loan, or a home loan, depending on what debt you're picking up. You could always make sure that you need to figure out how that particular investment is going to pan out. What's the allocation amount that you're going to do it, and over what tenure. This is these three elements, and as I said earlier, the debt APR, which is the percentage of interest that you pay. You need to make sure that your investments are working at a higher interest rate versus your debt interest rate. As long as you're doing that first rule right, then you need to look at the tenure and make sure that over a shorter tenure, you take a short term loan, try to cover that off, and then slowly, steadily, the investment grows long term. And over a long term path, if you keep taking smaller debts, repaying those, you maintain a good credit score, make sure that you're disciplined in investing, and over a period of time, that investment really grows to deliver the kind of long term growth that you're looking for.
Well, Tanuj, we hope you got your answer. Next up is Alam, and he wants to know, what are the potential pitfalls of using debt to finance investment, and how can I avoid them?
Yeah, okay, Alam, I think getting to know your risk better is something which is the key to this. And when you're looking at pitfalls using debt to finance investments, the most important part is making sure that you are not over leveraged. Like, you do not go beyond your means to finance your investments. That's the first thing. The second one is you need to understand what is the instrument that you're using and whether it's a short term debt or a long term debt, and the interest rates associated with it. Because every time even if your financial investments mature and you're going to pay off your debt, please make sure that you know what are the pre-closure charges before you get into any short-term debt. It could be a credit card, it could be a personal loan, anything. Everything has pre-closure fees. So please make sure that you look at these three elements.
All right. And next one is Mihira. Now, she wants to know, in what ways can credit cards facilitate cash flow management during investment projects?
Mira, credit cards, when you're looking at cash flow management, there would be two elements to it. One, in terms of a credit card loan, which will help you with the cash flow. You can get a credit card loan up to 80 to 90% of your credit card limit. That is something that can help. The other one is in terms of balance transfers. When you look at balance transfers, it can help you consolidate your debt and make sure that your overall cash flow that goes into debt management can be lowered. Some banks go with balance transfer promotions that would have 0% interest with a smaller processing fee, or some go with balance transfer at 2%, 3%. Those are elements that can really help you manage your cash flow. The third, and something that is very often used, is the conversion of big ticket purchases into EMIs or EPPs. So the installment plans really help you break down that cash flow and help you facilitate, you know, making a smaller payment every month and stretching it over a 6 month or a 9 month period, so that you can manage your cash flow effectively. I hope that answers your question.
All right. And with that, we have a last question, which is coming in from Salim. He wants to know, okay, what role do credit card bonuses play in enhancing his overall financial strategy?
Okay, so there'll be three elements to this, Salim. One is the welcome bonuses, that when you pick up a credit card, you, as I said, you make a spend of 5,000 or 8,000, and accordingly you would get a spend linked bonus that helps you in terms of getting a 500 or 800 dirham upfront credit. The second element would be in terms of, let's say if it's a cashback, then you go ahead and get a cashback every month for whatever spends that you make, and that can translate into a decent sum annually if you were to calculate that. The last but not the least, in terms of the benefits that you get off the card, it could be, it could be something like rewards or points that you accumulate for your spends, and otherwise you have your usual buy one get one offers, or you get 10% on booking.com or any of these aggregators that you digital aggregators or uh, merchants that you have. And the last one would be in terms of the travel. So these are three elements which will help you overall save a bit on each of your transactions, and that those savings can then be guided towards your overall investments or savings. That's how credit cards can help.
Perfecto. All right, Ji. So this brings us to the end of this segment, but don't go just yet. If you also have any questions about finance, about insurance, then simply, listeners, ask away. DM us on Instagram, follow Policy Bazaar UAE, or reach out to us via any of the other social media channels, and we'll try our best to answer your queries in the next episode. For now, though, I hope we're all fully up to date with our knowledge related to the role of leveraging debt and credit cards in significant wealth creation. We shall meet again in the next episode with more informative, with more insightful content, along with our lovely experts as well. Thank you so much, Sachin. Pleasure once again to have you on the podcast today.
It's a pleasure to be here and talk to your audiences. Thanks, Sid.
Thank you. That's it for today's episode, everyone. See you in the next one. Till then, take care and stay tuned.
You were listening to Policybazaar.ae's The Policy Project. We've got you covered.